Peter Lynch is a name that commands respect in the world of investing. As the legendary manager of the Fidelity Magellan Fund from 1977 to 1990, he turned a $20 million fund into over $14 billion, delivering an annual return of 29.2%. One of the greatest track records in Wall Street history. But what truly set him apart was not just his skill, but his simple yet profound investment philosophy: invest in what you know. His story is not just about numbers, but about how an ordinary observation can turn into an extraordinary fortune. This is the story of how Peter Lynch transformed a simple idea into millions, and how you, too, can apply his principles to your investments. Lynch's investment journey began at a young age. Born in 1944, he grew up in Newton, Massachusetts. His childhood wasn't filled with privilege. In fact, tragedy struck when his father passed away when Peter was just 7 years old. His mother had to work hard to support the family, which meant young Peter had to grow up quickly. At 11 years old, he started caddying at a golf course, a job that would change his life in ways he could never imagine. Why? Because it introduced him to some of Boston's wealthiest businessmen, many of whom worked in finance. As Peter carried their golf bags and listened to their conversations, he became fascinated by the stock market. By the time he was a teenager, he was reading financial newspapers and following stock trends. At 19, Lynch made his first investment. He had noticed that the airline industry was booming. People were traveling more and air traffic was increasing. Based on this simple observation, he bought shares in Flying Tiger Airlines, a cargo airline that was benefiting from the rising demand. Within a few years, his investment tripled. That early success gave him confidence, but more importantly, it cemented his belief that investors can find great opportunities in their everyday lives. Lynch attended Boston College, then earned an MBA from the Wharton School at the University of Pennsylvania. Afterward, he joined Fidelity Investments as an intern and eventually became the manager of the Magellan Fund in 1977. At the time, the Magellan Fund was relatively small, with only $20 million under management. But Lynch had a different approach from most fund managers. Instead of relying solely on complex financial models and Wall Street forecasts, he looked for investment ideas in the real world by paying attention to what was happening around him. One of his favorite investment principles was, go to the mall. He believed that if a company was growing rapidly and people were excited about its products, it was worth investigating as a potential investment. That simple philosophy led him to some of the greatest stock picks in history, including one that would become legendary, Legs Pantyhose. One day, during a routine shopping trip with his wife, Peter Lynch noticed something unusual at the local supermarket. Amid the groceries and household items, there was a new product catching the attention of shoppers: Legs Pantyhose. At the time, pantyhose were typically sold in department stores, but Legs had revolutionized the market by making their product available in everyday supermarkets. Their packaging was distinctive, a simple egg-shaped container that was easy to spot. This clever marketing move made pantyhose more accessible to busy women who didn't have time to visit specialty stores. Lynch's curiosity was piqued. Why would a mutual fund manager care about pantyhose? Because he understood that successful investing often begins with paying attention to consumer behavior. He began to research the company behind Legs, Hanes. What he found excited him. Hanes had identified an untapped market by distributing pantyhose in grocery stores, and sales were skyrocketing. Women loved the convenience, and stores couldn't keep the product on the shelves. Lynch believed that this kind of on-the-ground research gave him an advantage over other investors. While Wall Street analysts were busy poring over spreadsheets and technical charts, he focused on how real people spent their money. His philosophy was simple: if you notice a product or service growing in popularity, it could be a smart investment. After thorough research, Lynch bought shares in Hanes, confident that their innovative approach would drive profits higher. He wasn't wrong. As Legs became a household name across America, Hanes' stock price soared, delivering massive returns for the Magellan Fund. This wasn't the only time Lynch struck gold by paying attention to everyday products. Another famous investment came from a seemingly ordinary observation during a visit to his local pharmacy. In the early 1980s, Lynch noticed that people were buying over-the-counter stomach medicine in droves. One brand, in particular, stood out: Pepcid AC, produced by a company called Merck. He saw firsthand how demand for heartburn medication was booming due to changing diets and lifestyles. Lynch investigated further. Merck wasn't just selling popular drugs, they had a pipeline of new medications that promised future growth. Recognizing the potential, he invested heavily in the company. Over the years, Merck's stock climbed as the pharmaceutical boom took off, contributing to the Magellan Fund's impressive performance. This pattern became a hallmark of Lynch's success: spot a consumer trend, research the company, and invest before the rest of Wall Street catches on. One of Lynch's most famous concepts is the tenbagger, a stock that increases in value tenfold. For him, finding a tenbagger wasn't about luck, it was about recognizing simple but powerful consumer shifts early. Take Dunkin' Donuts, for example. In the 1980s, coffee culture was taking off in America, and Lynch noticed more and more people stopping at Dunkin' for their morning brew. Seeing the growth potential, he invested. Over time, Dunkin' Donuts became a tenbagger, delivering huge returns for the Magellan Fund. His advice to individual investors was straightforward. If you like the store, chances are you'll love the stock. This approach may sound simple, but it requires a keen eye, patience, and the willingness to act when you see an opportunity. Peter Lynch's "invest in what you know" philosophy wasn't just a catchy slogan, it was a powerful, repeatable strategy. He believed that ordinary people often have an advantage over professional investors because they interact with potential winning companies every day. From grocery stores to shopping malls, the next big investment opportunity could be right under your nose if you're paying attention. Lynch constantly reminded investors that you don't need to be a financial expert to spot a great company. He argued that average Americans, simply by observing what products they use and love, could often identify high-growth businesses long before Wall Street did. One of his most famous examples of this was The Limited, a women's fashion retailer. One day, while shopping with his wife and daughters, Lynch noticed how crowded a Limited store was. His wife mentioned that the store had trendy clothing at affordable prices, and his daughters seemed excited about their purchases. Rather than shrugging it off as a casual observation, Lynch did what he always did: he researched the company. He discovered that the Limited had a unique business model. Unlike other department stores, which carried multiple brands, the Limited focused on in-house private labels. This allowed the company to control costs and keep up with fast-changing fashion trends. Moreover, they were expanding rapidly across the United States, opening new stores in high-traffic shopping malls. The company's financials were strong, with increasing revenue and impressive profit margins. Recognizing the growth potential, Lynch invested heavily in the Limited. Over time, the stock skyrocketed, becoming one of his legendary tenbaggers. While Lynch encouraged people to trust their observations, he also emphasized the importance of digging deeper. Spotting a popular product or store was just the beginning. The real work came in researching the companies. Financial health: are they profitable? Is their debt manageable? Growth potential: are they expanding into new markets or developing new products? Competitive advantage: what makes them stand out from competitors? Lynch always balanced common sense with rigorous analysis. He didn't just buy stocks on a hunch, he conducted thorough research to ensure the company had the potential to grow for years. Another classic Peter Lynch success story involves Anheuser-Busch, the makers of Budweiser beer. In the 1980s, Lynch observed that Budweiser was everywhere, in bars, grocery stores, and sports stadiums. Americans loved their beer, and Anheuser-Busch dominated the market. Rather than dismissing beer as a boring business, Lynch saw it as a steady, cash-generating machine. He studied the company's financials and found a well-managed business with consistent profits and room to grow. His investment in Anheuser-Busch paid off handsomely, delivering substantial gains as the company expanded and beer sales continued to surge. For Lynch, every successful investment started with a simple story. A company like Hanes was making pantyhose easier to buy. The Limited was transforming women's retail. Anheuser-Busch was becoming America's favorite beer. If the story was clear, understandable, and backed by strong fundamentals, it had the potential to be a winning stock. Lynch advised investors to ask themselves a few key questions before buying any stock. What's the company's story? Why do you believe it will grow? Can the growth continue for several years? By focusing on simple, relatable stories, he consistently identified profitable investments that others overlooked. Peter Lynch believed that individual investors had a unique edge over Wall Street professionals. While institutional investors often overcomplicated their strategies, regular people could spot emerging trends simply by paying attention to what they and their families were buying. He famously said, "The person that turns over the most rocks wins the game." And that's always been my philosophy. This mindset helped Lynch turn ordinary observations into extraordinary profits. His approach wasn't about following the latest stock market fads or timing the market perfectly, it was about staying curious and doing the homework. One example of this came from a company that many people overlooked, La Quinta Inns. During his travels, Lynch began noticing that La Quinta Inns were consistently busy. Business travelers and families were flocking to these affordable, no-frills motels. While other investors ignored the motel industry, Lynch saw a hidden gem. He conducted his usual research and found that La Quinta had a cost-efficient model. Unlike large hotel chains that required extensive staff and amenities, La Quinta focused on offering clean, affordable rooms with lower operational costs. This allowed them to expand quickly while keeping profit margins high. Recognizing their growth potential, Lynch invested. Over time, as more Americans hit the road, La Quinta's stock soared, delivering another massive win for the Magellan Fund. While many investors chased exciting tech companies, Lynch often found opportunities in boring or overlooked industries. He understood that businesses selling everyday products like diapers, toothpaste, or fast food could quietly generate enormous profits. One of his biggest wins came from an unexpected place, Taco Bell. During the 1980s, fast food chains were booming. But while everyone focused on giants like McDonald's and Burger King, Lynch turned his attention to Taco Bell's unique model. The company had a simplified menu and low-cost operations which allowed them to open new locations quickly. More importantly, Taco Bell was meeting a growing demand for affordable Mexican-inspired food, a niche that other fast food giants had overlooked. After conducting his research, Lynch concluded that Taco Bell had massive growth potential. He invested, and over the following years, the company expanded across the U.S., delivering yet another 10-bagger to the Magellan Fund. Lynch believed that many investors missed out on these kinds of opportunities because they focused too much on complex theories or waited for the perfect time to invest. He argued that the best ideas often came from everyday life, but only if you were paying attention. He advised investors to avoid getting distracted by market noise or trying to predict the economy. Instead, he recommended focusing on companies with a simple business model, visible growth potential, a competitive edge. In his view, if you could explain why you were investing in a company in a few simple sentences, you were on the right track. To make investing easier, Lynch categorized stocks into three main groups. Slow growers, established, mature companies with modest growth, e.g., utility companies. Stalwarts, large, stable companies growing at a steady rate, e.g., Coca-Cola, Procter & Gamble. Fast growers, smaller, rapidly expanding companies with the potential for tenfold returns, e.g., Taco Bell or Dunkin' Donuts in their early days. Lynch focused most of his energy on fast growers, the companies with the highest potential to deliver huge returns over time. But he warned that these investments required patience and the ability to ride out market volatility. Peter Lynch didn't just make millions for the Fidelity Magellan Fund, he changed how people thought about investing. By the time he retired in 1990, the fund had grown from $20 million to $14 billion, making him one of the most successful investors of all time. But what made Lynch truly special was his ability to simplify the complexities of the stock market. He believed that anyone willing to observe, research, and stay patient could find winning investments. Let's break down some of his most powerful lessons that can still guide investors today. 1. Invest in what you know. This is the principle Lynch is most famous for. Whether it was Legs Pantyhose, Taco Bell, or Dunkin' Donuts, his biggest wins came from paying attention to everyday products and services. His message was clear. If you spend time in a mall or a supermarket, you can spot trends before Wall Street does. For example, if you notice a restaurant chain where the lines are always long, or a product your friends can't stop talking about, that could be a sign of a potential investment opportunity. 2. Do your homework. While Lynch valued everyday observations, he never relied on hunches alone. Once a company caught his attention, he would dive into the financials, asking key questions. Is the company profitable? Are they growing consistently? Do they have a competitive advantage? Lynch famously said, "The more you know about a company, the better your chances of making a good investment." One of his most profitable investments, Pepcid AC, by Merck, came from noticing a growing demand for stomach medicine, but his deep research into Merck's product pipeline is what gave him the confidence to invest big. 3. Look for 10-baggers. A 10-bagger is a stock that increases tenfold in value. These rare gems are what made Lynch's career legendary. He believed that small, fast-growing companies had the best potential to become 10-baggers. His advice? Don't be afraid to hold onto a stock as long as the growth story remains intact. Even if a stock has already doubled or tripled, it could still have room to grow if the business is expanding. One of his favorite 10-baggers? The Limited, a simple women's clothing store he discovered during a family shopping trip. Ignore market noise. Lynch knew that markets go through ups and downs, but he never let short-term panic dictate his decisions. During his time managing the Magellan Fund, there were several market crashes, yet he stayed calm and focused on the long-term potential of his investments. His famous line on market predictions was blunt. No one can predict the interest rates, the future direction of the economy, or the stock market. Dismiss all such forecasts and focus on what's actually happening at the companies. If a company was doing well, growing profits and expanding its market, he held on. This mindset helped him ride out the rough patches and deliver record-breaking returns. 5. Be patient. Big wins take time. One of Lynch's greatest strengths was patience. He understood that the biggest investment gains don't happen overnight. His strategy was simple. Find a good company. Invest early. Hold on as long as the company keeps growing. He encouraged investors to think of stocks like plants. If you nurture them and give them time, they'll grow. This patient approach helped him turn small ideas into massive fortunes. 6. Everyone can be an investor. Perhaps Lynch's most important message was that anyone could succeed in the stock market. You didn't need a fancy degree or a Wall Street office, you just needed curiosity, common sense, and discipline. He encouraged people to trust their observations and combine them with research. By paying attention to the products and services that improve daily life, you might spot the next million-dollar idea. Peter Lynch's legacy, what it means for you. Peter Lynch retired from the Magellan Fund in 1990, but his investment principles remain as relevant today as ever. His simple yet profound advice has inspired millions of investors around the world. Whether you're a seasoned investor or just starting, his core ideas still apply. Pay attention to everyday trends. Research before you invest. Be patient and think long-term. His life's work shows that some of the best investment ideas are hiding in plain sight, you just need to look closely enough. So, the next time you find yourself in a crowded store or notice a product everyone seems to love, ask yourself, could this be the next 10-bagger? After all, if a simple observation about pantyhose could make Peter Lynch millions, imagine what you might discover.